Thank you, Morgan. What are some of the key takeaways that we got from this conversation? Here are 8. Number 1, work with your nature, not against it. We all have biases, we all have flaws, and it's difficult to overcome these natural tendencies. Morgan recommends that we focus less on quote unquote overcoming our biases and rather on working around them.
I think the best we can do is become introspective about our biases and recognize that these are my flaws. I'm Morgan. This is what I do very poorly. These are the flaws that I'm susceptible to. These are my emotions that get out of whack from time, and embracing them.
If you've been investing for a while, you likely know what fears or actions you're susceptible to. Do you tend to panic when there's a downturn, or do you get really excited about the opportunities that happen when there's a downturn and you tend to raid your emergency fund in order to buy stocks at a moment when they're very volatile? Figure out how you tend to react and then plan accordingly. Are you subject to optimism bias? Are you subject to the availability heuristic and recall bias? What biases tend to trip you up? Observe that so that you can plan around it. If you have not been in the market for very long, if you're a new investor, ask yourself, generally in life, what do you excel at? And what do you, quite frankly, do poorly? What are your own strengths and weaknesses? Start noticing your thoughts and reactions to events that occur, not just in the market, but in life, and track them. Start observing yourself like an outside observer would, because self-knowledge is one of the most critical components to investing success. And so that is key takeaway number 1. Work with your nature, not against it. Key takeaway number 2. Save like a pessimist. Invest like an optimist. In his book, Morgan talks about having a barbell personality, being both paranoid about everything that could go wrong and optimistic about everything that could go right. You need to both get rich and stay rich. You need short-term paranoia to survive all of the uncertain problems that may occur in the future. Bear markets, a pandemic, recessions. This type of short-term paranoia helps you maintain a healthy amount of savings that allows you to weather those storms. You also need long-term optimism, a belief that over time, industries will thrive, businesses will continue to solve problems, businesses will continue to become more productive and make a profit, and that you as an investor can participate in that. Many people are good at one or the other, but not both.
The people who do well over the longest period of time are people who can embrace both of those sides. If you are just a pessimist, you're not going to get rich. And if you are just an optimist, you're probably eventually going to get kicked out of the game. You have to have both at the same time.
Pause for a moment to think about which side you lean towards. Do you tend to be more of an optimist or more of a pessimist? If you are a good saver, you're great at saving money, you're great at accumulating an emergency fund, but you're afraid to invest. You tend to be a little bit more anxious about investing. Recognize that and make a plan to learn more about investing so that you can become more comfortable with it and put more of your money in the market. Conversely, if you're one of those people who has no fear of the market and you have a tendency towards viewing the market as a high-yield savings account, you have a tendency towards having such optimism bias that you fail to keep a sufficient emergency fund and you fail to keep a margin of safety, if that is your natural tendency, then recognize that so that you can make sure that you establish a solid emergency fund for yourself. So that is key takeaway number 2, save like a pessimist, invest like an optimist. Key takeaway number 3, differentiate between patience and stubbornness. The difference between being patient and being stubborn is crucial in the world of investing.
Patience is you're just giving yourself the amount of time needed for stock market returns to accrue to you, for a job or a relationship to work out. Some things require patience in order to do well. That's a whole long-term thinking requires that. But stubbornness is when the world has changed and you just don't want to accept it.
Let's say, for example, that you invest a little bit of money in a startup and it seems promising, but you want to wait to see what happens before you invest more. In that example, you're being patient. Now, on the flip side, let's say that a company that you've invested in a lot already is going bankrupt and you're past the point of no return. You refuse to believe it. You refuse to pull your money out. You are locked in sunk cost fallacy. You can't let go. You're being stubborn. That's illustrative of the difference between patience and stubbornness, the difference between prudent caution versus magical thinking. Now, it can be incredibly difficult to figure out what a situation calls for. It can be very hard to know whether you are being patient or being stubborn, but you can try to recognize it within yourself, whether you're being patient or whether you're being stubborn, potentially by setting guidelines for yourself before you take an action. And then once that guideline is met, then you take the action specified prior to getting into the situation. So for example, maybe you decide to invest a small amount of money into a given stock. And if you decide before you ever take any action that if the stock hits X, you'll invest more, and if it hits Y, you'll sell. This might help you avoid stubbornness or avoid sunk cost fallacy. I'm not saying to do that necessarily. I'm just saying that's one of many examples of how you can, in advance, put guidelines or guardrails in place that save you from yourself. As Morgan talks about, it's important to have strong opinions weakly held, be durable and flexible, be willing to see where things go, and willing to cut your losses if your expectations do not match reality. As Morgan said, the odds of success will be more likely to fall in your favor if you are both durable and flexible, if you have strong opinions weakly held. So that is key takeaway number 3, differentiate between patience and stubbornness. Key takeaway number 4, stop moving your goalpost. One of the biggest challenges in the world of money management is figuring out how much is enough. Because enough can be a moving target. Figuring out how much is your definition of enough is difficult to do, particularly if you're on the path to financial independence. And that's why 1 more year syndrome is a very real thing for people who want to retire early or make a career change. That just 1 more year syndrome, just one more, now that we're here, let's move the goalpost a little bit more. It's common. It's very, very common in the FIRE community. And as Morgan says, the key to resolving our discontent, or the key to solving this idea that we may never have enough, is to stop moving the goalpost.
To me, the most important, but one of the hardest financial skills is getting the goalpost to stop moving in life, getting your goalpost of where you want to go and how much you need to stop moving. Because if you are someone who is fortunate enough to have a rising income, a rising net worth, but for every dollar of net worth or every dollar of extra income that you earn, if your expectations rise by $1 as well, you're going to feel like you're not necessarily going anywhere.
We need to manage our expectations appropriately, lest we get caught up in feeling like we'll never, ever have enough. And that being said, once you reach enough, of course, everybody needs goals. A meaningful life is one in which you're working towards a target. You're making progress in something that motivates you. So certainly, not moving the goalpost doesn't mean stop setting goals. It simply means recognizing what's icing and what's cake. What's enough and what's more than enough. One way to do that is to have a gratitude practice. Being grateful and focusing on what you do have can be very helpful for helping you realize that you already have enough, perhaps financially or perhaps in other non-financial forms of wealth. Morgan wrote a great article about this back in August. We're going to link to it in the show notes, and those show notes will be available at affordanything.com/episode 284. That's affordanything.com/episode 284. And so that is key takeaway number 4. Get clear on what's enough. Key takeaway number 5. Bubbles are not the result of high valuation, but rather the result of shortened timelines. Now, this blew my mind when I first read it in his book. As Morgan explains, when there's momentum in stocks, day traders naturally want to hop in and exploit that momentum for short-term gains. And so when those day traders hop in, they increase the stock prices. So stock price grows rapidly, trading volume grows rapidly, and a lot of buy and hold investors might be left wondering, geez, should I get in on it too? What happens is once the day traders have had their fun, they sell and long-term investors are left holding the bag. So unfortunately, it's all too easy for us to take cues from day traders, but we shouldn't. It's important, therefore, to be aware of who we are taking our cues from.
The takeaway here is that It's often viewed like we're playing one game in investing. We're all investing in the stock market. We're all investors. It seems like the same game, but people actually play very different games in the stock market. There are day traders, there are high frequency traders, there are people who are investing for the next week, the next month. There are pension funds and endowments that are investing for the next century. We're all playing very different games, even if we're playing on the same field.
The next time you find yourself caught up in hype around a stock, a company, a trend, take a step back for a second and ask yourself who you're hearing this from. Are you hearing this from someone with wildly different investment goals than what you have? Because depending on your goals, you'll need to seek out advice and camaraderie from people who have similar philosophies, similar goals. Follow their lead. Don't take advice from people who are playing a different game. And in the world of investing, you may have a whole bunch of people who are all investing in the stock market or investing in real estate or investing in whatever, but those people are playing different games with different timelines and different ultimate end goals and different risk tolerances. And so you'll want to make sure that you're listening to the people who are playing the same game that you are. That is key takeaway number 5. Key takeaway number 6. Bonds and emergency funds, bonds and cash, have a higher return than you think, meaning that they have an invisible return or an indirect return. Many people are torn about how much cash they should hold or torn about asset allocation because they're afraid to hold too much of an asset that in their eyes doesn't produce good returns. It's not an amazing feeling when you realize that you have savings sitting in a savings account that's earning next to nothing. But the purpose of having bonds in your portfolio or the purpose of having an emergency fund or cash reserves is not to provide us with returns directly. In fact, it's to provide us with a safety net, with a margin of error that enables us to take on more risk in other elements of our portfolio.
I'm going to own some assets that are capable of producing really high long-term returns. And I want to own other assets that protect me from being thrown off course from those assets that will earn a long-term return. So let's say I own stocks and bonds. The reason that I own bonds is to guard me from ever being forced to sell the stocks that I own. That's the sole purpose of the bonds that I have.
Morgan goes on to explain that if we're ever in a bad situation and we're forced to sell our stocks, that could result in a catastrophic loss that we may not recover from. And so if having bonds or having cash protects us from having to sell stocks, then they factor into that high return. The same story is true with keeping an emergency fund or keeping cash reserves. That's why it's often referred to as an FU fund. Having cash gives you greater freedom and flexibility and choices. And that freedom and flexibility might not have a direct return in the form of the account that it's sitting in, but it has a huge invisible return in the fact that it gives you the flexibility to pursue opportunities. So you'll have choices as a result of having cash reserves that you wouldn't necessarily have if those savings didn't exist. And so if you feel poorly about the low interest rate on your savings account, don't feel bad about it because you are getting a good return on it indirectly. You are getting a good invisible return in the freedom that it's giving you to pursue other opportunities and to be more aggressive in other elements of your portfolio. And so that is key takeaway number 6, that bonds and cash have an invisible indirect return. Key takeaway number 7, don't get too attached to a forecast. When you get attached to a forecast, a financial forecast, you're getting attached to one specific reality that you project or forecast to occur in the future. But there are many possible ways that the future can unfold. You can't plan for everything, but you can have a certain set of expectations, a range of expectations that can help you prepare for future unknowns.
I do think that there is a big difference, though, between a forecast and an expectation. A forecast would be like if something where I said, the next recession is going to happen in Q3 2022. That's a forecast. An expectation is, look, historically, there have been about 1 to 2 recessions per decade. And I expect that in the future, that's going to be roughly the same. I don't know when they're going to happen. I don't know where they're going to occur, what's going to cause them. But I expect there to be some level of recessions and bear markets and whatnot in my future.
There's a famous quote that I absolutely love from the legendary investor Benjamin Graham that says, "The purpose of the margin of safety is to render the forecast unnecessary." And so this ties in with what we were just talking about in the previous key takeaway, that the purpose of that margin of safety, those bonds or that cash, that emergency fund, is to render the forecast unnecessary. It's essentially another way of saying to provide flexibility, right? The purpose of the margin of safety is to render the forecast unnecessary. And if we are rendering forecasts unnecessarily, then by definition, we are not getting too attached to forecasts. We are substituting forecasts for a range of expectations and for probabilistic thinking. And that is a much more mentally flexible way to approach the way that we think about investments. And so that's key takeaway number 7. Don't get too attached to a forecast. Finally, key takeaway number 8. Tail risks, which are risks of low probability and high impact. Those tail risks move the world. If something has a low probability of occurring, it's natural to think, that'll never happen, and to brush it off. And worse, if something has a super low probability of happening, it may not even cross your mind at all. You might not even consider it. And unfortunately, that's how Morgan learned the lesson that he shared with us during the interview.
Skiing out of bounds, we were not supposed to do. We knew that was risky. But we thought that the consequences of our risk might be that we would get our season passes pulled if we got caught, that our coaches would yell at us, maybe that we would break our legs, blow out your ACLs, which is almost like a rite of passage for ski racers. That was what we thought the consequences of our risk were. We never in a million years thought that the consequences of the risk that we were taking would be that we'd end up dead. Never.
Risks that are low probability and low impact are not something to spend a whole lot of time on. But risks that are low probability and high impact, those need your attention. And of course, risks that are high probability, of course, also need your attention. But low probability, high impact, low probability, high magnitude, those tail risks deserve a lot of attention because it's natural to brush them off, but ultimately, those are the ones that make the biggest difference. Those are the ones that move the world. So recognize those tail risks and use this recognition of tail risk to give you another framework from which to make decisions and assess your risk tolerance. A previous guest on our podcast, Dr. Gleb Sapersky, who is an expert in disaster avoidance, says, you want to plan for extremes. You want to plan for both extremes. So it's easy to brush off tail risks, but it is unwise to do so. As you think about your investments, make sure you're thinking of tail risks as well. That is key takeaway number 8. Thank you so much for tuning in. This is the Afford Anything podcast.